All right, so let me start again by thanking Jim and Avner for inviting me, and it's been a great conference so far. And I really like reading this paper, not only because that I'm interested in this research topic, but also because it reminded me of my banking days in India, where I spent 4 years before I got my PhD. And I was looking at this data. I said, some of my loans could be there in that data set, perhaps. And now, I got this paper from Jason and Jose 10 days ago, and when I looked at the paper, I saw that there is a skeleton of a paper there, and as Jason pointed out, it's an early paper. So as a discussant, if I said that for any other paper, it would have been bad news for the authors. But this paper is about anatomy, so if I see a skeleton, I am happy, and in fact, I want to see more bones in the paper as I go along. So jumping directly into the paper, let me briefly talk about what this paper is trying to do. So they have a multinational bank, MNC bank. Think of that as Citibank or Bank of America. They operate in many emerging markets, and from their New York headquarters, there is this shock that across the board, they have to cut 20% of lending. So what do they find? Indeed, they find, consistent with that policy at the corporate level, there has been a decline in loans made to all the borrowers. And that's not really that surprising. The headquarters is asking you to cut 20% of your loans, and you do see that in the data. So where the paper is really trying to make some contribution is that where is this decline happening? So there are many results, and the two themes that comes out again and again is that this cut is happening across high-risk borrowers, and this is not so severe if the borrower is able to pledge non-specific collateral, such as cash or real estate. So interesting work on that front. My first, the way I'll structure my discussion is just talk about a little bit the broad theoretical point that this paper is trying to make, and that would hopefully help them organize what results they have, and hopefully tease out some of the issues which are still, I believe, important in terms of identifying this lending channel friction that you have in mind. So the idea that supply-side frictions can affect outcomes on the borrower side in terms of the amount of loan that they will get, or something that would happen with their investments or so on, it's been out there, going back to early papers in 1980s and subsequently a bunch of other papers in the recent years, both at the macro level and at the micro level. So my focus and where this paper can contribute is on the dimension of where does that happen? And Jason was very clear in terms of making that point. All right, so let me spend 1 minute talking about what are we really after here. So why do we care? Where is the welfare loss, if any? Now, I'm thinking about a small borrower in an emerging country that has this relationship with this MNC bank. And in this relationship, information is being shared between the bank and the borrower, and loans are being made from the bank to the borrower. And over time, there is a sense in which this bank has some special information about the borrower. Bank knows something about the borrower that perhaps other people don't. Or bank is able to control or affect some behavior of the borrower that other people are not. So that's the starting point in most of the theoretical models which we see in this literature. And then comes a shock where this relationship that we had and that we invested in somehow is not going to give us loans going forward. So bank is unable to lend. Now, the story becomes, there are two parts from here in the story. One is interesting for us as financial economists, and one is not so much. If after the shock, borrowers can go to the outside market, bond market, other banks, in these countries, non-banking financial institutions, NBFC as they would call it in India, and if they can substitute whatever they lost from this MNC bank, and still take their positive NPV projects, then there is no welfare loss. The reason we really care about is that what happens if there is no substitute available for one reason or the other, and that's where the anatomy becomes very important, in my opinion. And the borrowers go to the second path, that there is no loan, and there are some real suboptimal investment decisions being made. Think of that as a positive NPV projects being let go of simply because this borrower could not get money from the MNC bank. So the real issue here, and if you want to think in terms of the counterfactual, is that do I land in the this big box there, or do I end up going there? The important point for your paper is, so once I see this big structure, the anatomy to me is pretty clear. That for anatomy, what I'm looking at are what are these frictions that might prevent the borrower to go from here to here? Or what is it about this relationship that is preventing this borrower from tapping these alternative sources of funds? So these are the margins where, in fact, it would be the paper can contribute. So to be precise, once you see that picture, that tells me that the reason we care about this lending channel is because either there are credit market imperfections at the bank level, so there is a bank that is not willing to fund a positive NPV project of a borrower. And if you could tell me something about that, what could that be? That's interesting. Or there are credit market imperfections at the borrower level. That what is this moral hazard or information problem? That would typically be one of the two themes in most of this theoretical literature. Or what is it about the interaction between these two credit market imperfections at the bank level and the borrower level, which typically comes from the regulations you might have at the macroeconomic level on the capital or reserve requirement. And I would encourage the authors to structure many tests, interesting tests that they have under these broad buckets. It would really help your readers a little bit also when you present your results. So I'm going to view anatomy of credit supply shock through the lens of these three credit market imperfections. To be precise, questions, before I jump into questions that you have answered, questions that I have for you, given that you have such an interesting data, is that, so what frictions or micro foundations of these economic models you have that show up in non-availability of funds, even for a positive NPV project? So one thing that I was seriously hoping to get out of your paper, which right now, again, it's early work, so it's not there, is that did it really matter for these borrowers? That's what I'm talking about. And if it did, what is the relative importance of these imperfections at the bank level, at the borrower level, or at the economy level? To be precise, you can have a world where it's all about informational frictions at the borrower level that stops these borrowers from going to a non-relationship bank. That is, that stops these borrowers from going to the bond market. Is it all about some kind of moral hazard? Now, your result on collateral is consistent with some of these stuff, but I would encourage you to put it in that perspective. Alternatively, where your paper is really silent, and I think there is a huge opportunity for you to exploit, is that there could be frictions at the bank level. That is, you can have bank's own debt overhang problem. That bank is letting go of something positive NPV for one reason or the other. Or bank's internal information processing is the reason that is creating some sort of imperfection on that front. Now, why I say that you have an opportunity there is that, yeah, sure, you have one bank, but you have one bank across 6 countries. And there are cross-sectional differences in some of these dimensions for the same bank in Chile versus India versus Turkey. And you perhaps want to exploit that. Or is it something about the economy, that the bond market is not developed in one country versus Slovakia versus India that you want to exploit? And could it be that is creating that suboptimal behavior? So these are the questions that I would have for you. And you have answered one of this in terms of the collateral or the borrower level moral hazard, hopefully, which is hidden in your collateral argument. All right. So now jumping directly to the paper, what they have is a simple form fixed effect design, and I've just put it in the regression model. This is what is being done, that you have a shock period. Before that, you have one bank that is lending $100 to this firm. And after the shock, the same bank is lending $90. That's the 9 or 10% decline that you show in your regression model. But this is within firm change in the debt level from the same bank. And that, to me, is a little bit less than completely satisfying. The reason being that The counterfactual or the margin of difference that I had in mind was something of this sort, that you stay with your MNC bank and your firm 1. I want to compare this amount of loan A with, after the shock, did this firm go to some other bank and got this C? So the margin of difference I'm looking for is A versus B plus C. And yet better, what I'm looking for, and I know you don't have that much data, but if you could, that if you could look at this difference, i.e. the difference in the total debt that the firm could got that borrowed from the shock bank, and compare that to a borrower which is in the sort of similar industry and perhaps facing similar kind of informational and agency frictions. So the difference there would be B plus C minus A for firm A as compared to the same difference for firm 2, a different diff kind of analysis. 4 minutes? All right, so I'll be a little bit quick here. All right, so let me try to jump to your empirical model. Now, you spend a lot of time in the paper and also in presentation talking about that, look, this shock is exogenous to the credit demand. The real identification issue in my mind was not that you identified the effect of shock, but you identified the effect of interaction term. And for that, I think there's more work to be needed to be done to convince your referees here. Think about this. Think about, in the interest of time, let me just jump to an alternative model, which is non-informational, non-agency-based benchmark world. So I remove the credit market imperfections that all these learning channel models have in mind, and just talk about, look, this bank decided to cut 20% lending. Maybe the bank is simply trading along this risk-return trade-off domain and is trying to cut risky lending. Perhaps because they are constrained on the capital side here in New York. Yeah? In that world, what will you do? You'll cut a small, medium business lending in emerging markets. They are risky lendings. It's nothing to do with the information or agency friction, simply a portfolio readjustment for the MNC bank. You would cut lending for high-risk borrowers. And you would only approve loans when it is collateralized, where you have less capital requirements. So the point is that this interaction channel could be consistent with this non-informational benchmark model. And your argument has to be, or at least the way I'm reading it, is about the bank lending channel where information is the crucial thing. So how do you tease that out? So that's something that I would encourage you to think about. All right. Similarly, you can think about the level of competition that maybe this bank could not compete in India in a small and medium scale lending. So maybe this is an inefficient bank getting out of that market, which could be, in fact, welfare improving rather than welfare decreasing. So how do you tease those things out? My suggestion would be that you exploit heterogeneity and informational frictions across the borrowers. You analyze debt received from all sources. And more importantly, if you can, I know it's hard toss, but if you can show me that somehow there was some real impact, that these borrowers cut their investments, they lost their value, I would like it much more better. All right, now the 2 minutes that I have, so I'll skip this and talk about something that you are not doing, which I think you can do. Is about when you think about the anatomy at the bank side or the economy side, can you exploit cross-country regulatory differences in disclosure requirements to assess the effect of informational friction? What is it about the bond market that is not funding a small borrower that has a positive NPV project? Or can you exploit differences in the degree of development of the non-bank lending channels across countries? That do you have a bond market or not? Yeah? And finally, I think you have a nice setting to exploit differences in reserve, liquidity, and capital requirements across these countries. Because one of the things, if you go back to the earlier Bernanke-Blinder papers, is it's all coming from the reserve requirements. And capital and liquidity sometimes are tied in together in these models, but you can tease them out that did it matter if your country had more or less reserve requirement? Yeah? All right, so I think paper can do a whole lot there. Now, I'll skip some of these tests and I'll, in the interest of time, and talk to Jason and Jose separately. Overall, I think it's a good paper. You can make it really good if you can exploit some of these differences, in my opinion. And I enjoyed reading it. Thank you.